Hey everyone, in this video I wanted to highlight one red flag for Disney stock investors in 2023 and beyond. Now, you all may already know that Disney has several segments to its business, including its theme parks, cruise ships, hotels, box office, streaming, and the cable segment. Of all those areas, the one red flag I'm going to highlight is in the linear networks, the cable division, where people subscribe to cable connections bundled, where Disney's content gets delivered through them through a cable or satellite connection. That segment has been on a downward trend ever since really the rise of Netflix roughly a decade ago, where people have prefer to stream their content over getting it through a cable connection. And if you think about it, it's just natural, right? If you pay for a subscription through cable, you're probably paying a higher price monthly. And at the same time, it's less convenient because you could only watch that content when you're at home or the office or wherever you might have that cable connection. Versus if you connect through streaming, let's say you buy Disney Plus or Netflix or a bundle of a bunch of different streaming services, you can watch that content anywhere you can take your phone, which is almost anywhere here in the US at least. You can get a connection and you can watch your content on your phone. So on the bus, in the car, on campus, during a lunch break at work, wherever you might be. So it's only natural that people slowly transition, well, maybe not even slowly, but transition from cable subscriptions to streaming subscriptions. And that's a red flag for Disney because it still generates a significant amount of revenue and operating income from its cable subscriptions by selling its channels to cable subscription providers, right? Like ESPN, right? Disney gets money every time somebody signs up to a cable bundle that includes ESPN. Disney gets a nice little average revenue per user from that. So in its most recent quarter, Disney said operating income at the linear networks decreased by $1 billion compared to the same quarter last year. Second quarter domestic linear network affiliate revenue decreased by 2% year over year. That was driven by a 6% decline from fewer subscribers, partially offset by a 3-point increase from contract rate increases. So, what Disney has been trying to do is offset fewer subscribers by charging more per subscriber. So, at the same time, people have been canceling their cable subscriptions. Disney has been raising prices. I don't know how effective that strategy is. Maybe Disney is thinking, you know what? There's a core of sports fans that are not likely to cancel their cable subscription as long as that's really the only place they can get live sports. And so if they're going to stick around, let's make them pay higher prices. That could be what's going on here. Or it could be that these higher prices are hastening the cancellation of cable subscriptions in favor of streaming. That remains to be seen there. In addition, domestic linear advertising revenue decreased by 10% year over year. Ad revenue decreased 10% year over year. That's partly, why the linear networks has been so lucrative for Disney. On top of the per subscriber fee that Disney gets for someone paying for ESPN, Disney also sells a ton of advertising on ESPN, right? If you've been watching the NBA playoffs, I actually watched a couple of games. They advertise, it seems like, in every moment of every minute of the game. In addition to the commercials, Disney is selling advertising in every break of the game. This, for example, it could be a free throw and Disney will say this free throw break is brought to you by AT&T. And then the next free throw break is brought to you by T-Mobile. And then the next free throw break. So there's advertising in the game and then there's advertising in the commercials. So Disney generates a significant amount of ad revenue during the during these games, and so it makes money from selling you the you're paying a monthly subscription for cable, then it's also making money from all that advertising. It was a very lucrative setup for Disney, and the fact that it's now losing this business in favor of streaming raises this red flag. Raises this red flag because it's uncertain the profitability where the profitability of the streaming subscription will end up. Will it be when it's at equilibrium, when the whole thing shifts over to streaming, right? Because that's the direction it's heading. It's not there yet. There's still, Disney still has 70 million ESPN subscribers from a cable, subscriptions. So it's eventually going to go to, you know, I don't know where it settles. It's not going to be zero, but whenever the equilibrium point is, when the exodus stops and it's at a stable level, what's the profitability going to be like? Is it going to be as high as it was when they were delivering the content through cable? That remains to be seen. And just the fact that that transition is not going to be smooth, it's going to be choppy, and the question mark around what the profitability is going to be is a big red flag for Disney stock investors in 2023 and beyond. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.